Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Welcome back to Options Insider Radio. Our next guest is an old friend of the show. You've been on a number of times now, Gary. I've lost track, actually, of how many times it's been, but we always love to have you on and share some of your perspective on the industry and what's going on at the ISE. I'm speaking, of course, about Gary Katz. He is the CEO of the International Securities Exchange. Gary, welcome back to the show.
Thank you, Mark. It's truly a pleasure to be here again.
Oh, I'm glad we can have you. And before we even get started, let me just congratulate you and your team on an excellent conference. You guys put on quite the show this year. I am very impressed. Your team really did an excellent job.
Well, thanks for the compliment, but it also works out very well because we're able to hand over to the NYSE as well as OCC that's going to be helping out next year all the detailed plans, all the steps in putting a conference like this together. So they're going to be in a much better shape than we were at the start of this, and we've learned a lot, and that's really the reason we're using OCC going forward as a constant, because instead of each exchange learning from mistakes, we can pass the knowledge on from one group to the next.
Yes, it definitely makes sense to have one core group handling most of the thing as opposed to different exchanges staffing up every year and then changing that around. Let's dive right in. There's a lot of things that we could talk about, a lot of interesting topics. I think one of the most interesting ones is one we've actually visited several times in the past, but it keeps popping back up, and that is, of course, maker-taker versus traditional models. A few years ago, everyone was up in arms. Maker-taker was the new thing. And about a year ago, actually, at this conference, we talked about it again. I took kind of an informal poll of most of the different heads of the exchanges. We talked again, looks like maker-taker had plateaued at the time, and the consensus was, yourself included, was maker-taker would probably settle out somewhere around 20% of the overall market. Now, all of a sudden, maker-taker seems to be flowing again. It's all of a sudden we have Philly taking on sort of a hybrid model with maker-taker and traditional. You guys are flirting with that and have put your toe in that water as well. We have multiple exchange groups that have both models under the same umbrella. And so it seems that maker-taker is definitely on the rise again. So first off, let's talk a little bit about why you decided to dive into those waters. And then B, where do you think maker-taker is headed? Are we looking at 30, 40, 50% of the market in the near future?
Well, I think we need to go back to that time in April, May of last year when everybody thought that it would stay capped at about 20% and understand what changed. And two things changed in the industry. One is volatility continued to fall. Measures of volatility are at near record low levels. And what that has allowed is a much tighter spread between the bid and the ask. And in that world, maker-taker flourishes. The second element that has changed is that an exchange, Philadelphia, and they deserve a great deal of credit for it, experimented with a combination of maker-taker, which is a pricing structure, and their market structure, which is what ISE had introduced, the pro rata with customer priority. Up until that time, maker-taker had been combined with first in, first out, and it had limited success. What the Philadelphia model showed is that the two combined together produce a different effect, one that really nobody had anticipated. What we've decided to do is what we always do, which is to try to tweak things, not just copy what a competitor is doing, but to learn from what that competitor is doing. So again, compliments to Philadelphia on their model, but we wanted to take it and adjust it and try to affect the behavior of our market makers. We've always believed that what drives success from an exchange perspective is the quality of the markets that are produced on its platform. We wanted the bids and offers of the ISE to be the best bids and offers in the market with the greatest depth. And so our modified maker-taker doesn't just provide a rebate to anybody that provides liquidity. What we've done is we've focused that rebate on those market makers that are on the national best bid and offer 80% of the time, either the best bid or the best offer over an entire month. and over a large number of series. So what we want to do is reward the market maker that is making quality markets in all of the products that we trade. And the results have been dramatic. In the 3 names that we have tried this modified maker-taker on starting in April, the quality of the markets have improved. We're now on the MBBO along with the best markets, and we are providing rebates to the market makers that are making changes to their market-making models to stream in better quotes to the exchange. We believe that will drive order flow to the ISE and create a proper balance of risk and reward.
Have you seen an influx in order flow and volume in the names that you experimented with this?
It's very hard to tell because only a month has gone by, and what we've seen is a mix in terms of volume and where that volume is taking place. And because it's only a month and it's only 3 products, a large trade on one exchange or another exchange can affect the market share numbers. And so I'm not ready yet to decide that this was or was not successful from a market share perspective. But if you look at the fundamental measure of success, which is did the quality of the markets improved, they did dramatically, and everything else will come naturally.
Now, speaking of market share, obviously the ISE has made some headlines lately. There has been a decline in your market share year over year, and I'm curious, you mentioned the PHLX experiment with the combined models. Do you attribute a lot of that decline to that? Do you think PHLX has taken that directly, or where do you think a lot of that market share has gone over the past year?
Well, the people that work for me at the ISE will tell you that I readily give out compliments, but also when something's not right, I'm not shy in letting them know. So I give Philadelphia the compliment for their experimenting with maker-taker, but one aspect of their market share and volume are the dividend strategies that we've been talking about and trying to bring some attention to publicly. And that is a piece of the market share decline for ISE. It's created a great deal of volatility in market share. The trades that Philadelphia is doing primarily are distorting market share. So that's one element.
That's probably a relatively minor element, I would think of it overall. The dividend trades, they were substantial, about 3% of overall volume last year. But you think that's directly attributable to a lot of what's going on at the ISE right now? Or?
Well, it's one piece of it. The other piece of it is the crossing business that we lost in the middle of 2009. And as you'll recall, we had a rule filing for a functionality called Qualified Contingent Cross, or QCC. The SEC had approved that rule. I talked about it with you the last time we did the show.
Several times.
And that's still pending at the SEC. They published for public comment the data that they had collected and analyzed. As you would expect, we thought that the data confirmed what ISE was saying, and the CBOE felt that the data confirmed their position, that's good. That's good competition. And it's still pending at the SEC, but it's an important piece of the business that's missing, and that is the large crossing trades. More important today, maybe even than a year ago. As we heard at this conference, because the retail investor is still uncomfortable and has not fully come back into the market. I think they need a little more convincing. I've always felt that when housing prices stabilize and the unemployment rate begins to go down, the retail customer will begin to come back into the market. We've had the firming up of housing prices, but we've really not yet seen a change in unemployment figures. So they have not come back into the market as strongly as the institutional traders. And those institutional traders typically trade in larger size, and they look for liquidity from the upstairs trading desks and IDBs, which are groups that find liquidity for both sides of a trade. They typically then bring those trades to an exchange where they're crossed, and that's the piece that we're still missing. And I would say that's the primary reason for the market share drop rather than the dividend strategy, which is, as you said, it's about 4% of the average daily volume last year. I think that's a significant number,
yes, it
but
is.
Clearly not the primary reason for the drop. And then the third reason, very difficult to measure, is the pending IPO of the CBOE and the remutualization of the Amex. And while that's not yet a closed deal, we have seen shifts in order flow to the future owners of the Amex, and that's something that's just a part of the competitive landscape and we'll have to deal with. But those three issues are what explain the drop in share that's taken place at the ISE.
You've touched on three things that I definitely want to dive into in a little bit more detail. We'll start with the dividend trades because you have mentioned those several times now. I've had most of the exchange heads on this show, and I bring up the dividend trade problem with them. It's interesting to see the different responses that I receive. As you can imagine, the Philex people are a little more non-committal about pulling those kind of trades out of the volume. Other ones are kind of against them. And some, like Ed Boyle of NYSE, seems to be kind of indifferent to them overall. I know this has kind of been almost a personal crusade of yours on the dividend trade. And I've been right there with you, actually. I've been writing about these and talking about these I looked back on the site the other day. It's been, I think the first one I saw was probably about 4 or 5 years ago. So this is something I've kind of been hitting on for a while too, but it doesn't seem to have gathered the resonance. I mean, for example, ISE pulls out these out of their numbers, but other exchanges aren't doing the same thing. That's a simple, basic thing that they could do. And that's something we've talked about before, improving the volume numbers and the quality of the numbers we're putting out there. So I'm curious, what do you think about the responses, even the other day from the exchange leaders panel when you brought up the dividend trades? It seemed most of them were kind of non-committal at best about pulling out dividend volume and other exploits like that.
Well, the first thing that ISE is going to do is we've made a decision that this volume and the dividend trades that are a piece of that volume, they do need to be calculated and displayed on a daily basis. So we will be publishing that on our website. I don't have a start date for that yet, but it's our plan post the trading. So the next day, we will indicate what the volume figures were for equity options for each of the 8 exchanges and pull out the volume associated with dividend trades. And that'll be available publicly for everybody to see, and shining light on an issue and creating transparency around that issue is probably the most important thing that we can do right now. I've always said that this is not an illegal trade, and I certainly was never accusing any exchange of doing something illegally. You said it right, Mark. It is a personal it is personal for me.
It's your crusade.
Yes, that was a good word. Because in the past, personal crusaders have gone public with issues that were not illegal in the marketplace. They pointed out issues where there was discrimination. They pointed out issues that were potentially going to become a problem. Or they pointed out issues that were just going to damage the brand of a product or of a firm, and they typically get ignored. So I'm comfortable that that's the possibility, yet at the same time, I'd like to believe that we're beginning to learn from history. And there are just too many times where you do have a problem in the markets, and only after the problem do people say, something, we always knew about that. We always knew that was an issue, but we never did anything about it. And there are many examples of this. The one that comes to mind is today we have a separation between a firm's analysts and the group that take a company public. And that was something that was done because there was a conflict of interest with the analyst being on the same side as the group that received commission or payment for bringing a company public. I think your listeners can see that conflict as clear as day. You've got a group saying this is a great company, you should buy this. It's a company that you want to buy in the public market. The firm then got paid based on the level at which they were able to get investors in, and then you would find out afterwards that the analysts, they never really believed that was a good trade for the customers, but there was a great deal of pressure on them. So regulatory change took place, and there's now an information barrier between those two so that you're getting a proper neutral opinion when an analyst gives you their opinion on a stock.
So what would be the ultimate end game, you think, for you in terms of the dividend trades? Do you think it's enough to simply exposing them on your site and pulling the numbers out that way? Would you like to see self-action from the other exchanges following suit with you, or are you looking for actual regulatory enforcement on this?
Right now, I'm looking for sunshine. The more people know about it, the closer we will come to the point in time where either the exchanges will self-police themselves, or a regulatory body like the SEC will say, I recognize that there's nothing illegal about them, but these create systemic risk. When you do these trades, there is the possibility of a firm being unhedged if the stock moves dramatically, or the firm makes a mistake when posting these trades that create a financial problem in the marketplace for that firm and potentially even for the clearing member. And there have been examples of this in the past, and maybe something has to happen where somebody does lose a lot of money, and at that point everybody will turn around and say, that we should have listened to that personal crusade. That was an important issue. We all knew it was there. We all didn't like these trades, but we let it happen.
The SEC cloaks itself as the defender of the little guy, and what we're seeing a lot from our own audience, basic retail, high-end retail, even institutional. A lot of people are starting to come into the option space. They're learning how to trade options. They're learning how to track volume and use that to inform their trading of the underlying, and we're getting a lot of emails whenever these trades are going up. So I guess maybe selfishly it's good for us because we're getting a lot of traffic out of it. But people are confused. They're watching options volume to inform their trading of the underlying, and they see these massive spikes, and they don't know what a dividend trade is. So what is going on with the underlying? What is happening? What am I missing about this? And it's really throwing off how they trade, and it's a very confusing element for them. So just in terms of confusion and putting people off of the options market, that effect alone in and of itself is a serious detriment from these types of trades. And it kind of just speaks to the whole fact that the type of volume numbers we're pushing out at the end user right now is more of a fire hose than it probably should be and is useful for them. Your end user who sees volume numbers coming out of them that include dividend trades, that include trades that are routed away from one exchange to another, and other sorts of things that make the numbers not very transparent and not very useful for the end user. I think there's a lot we can do to tone down that fire hose a bit, maybe turn it into a spigot or even a trickle.
I agree, and I would add one more thing to that, and that is exchanges today are in some cases public entities, and investors in the shares of those companies look at volume as an indication of profitability. These trades are not correlated with profitability because the exchanges that are encouraging them for market share and for very little revenue. And so you're in essence painting the tape and creating an illusion that that exchange has a certain level of market share. And today we translate market share into an exchange is doing very well from a P&L perspective, and that's not the case when these trades are being done.
Well, you'll be happy to know that it's something we've done for a while on the Options Insider, because we do a lot of, obviously market share analysis and volume analysis, but we do take that extra step to pull out those low-hanging fruit exploits like the dividend trade, so we can kind of get a little more accurate reflection of what's going on in the industry for our readers, and people seem to be responding to that. So that at least I think will help you sleep easier at night, a little bit at least.
Thank you.
Now, you've mentioned another thing I want to talk about, which is, of course, some of these different models that the exchanges are taking on the ownership side. The people are experimenting with the old PhilX model, which is the PhilX show that if you sell off pieces of your exchange to order flow providers and liquidity providers, it can work out relatively well for you. And so other exchanges are trying this with varying degrees of success. Amex obviously is in the process of doing it. BATS, the new exchange that just launched, one of their core value addeds they claim is that they have this ownership model where people will route order flow to them. I know you've experimented with it in the past. So I'm curious, A, if you think this is the wave of the future, and B, is this something you're going to experiment with again if you're seeing every other exchange group out there has at least one entity that has partial ownership from order flow providers and liquidity providers?
It is the wave of the future, and another example, we've seen articles written on it and heard the CEO of the Toronto Exchange talk about remutualizing their ownership in BOX. So that is owned, I believe, 53% by TMX, which is the Toronto Exchange, and they've talked about selling off pieces of that for the specific reason that you just talked about, and that is that if a broker-dealer owns a piece of an exchange, there is a good chance that they're going to support that exchange, whether that's through market making or through order flow and liquidity. So I think it's going to continue to occur. It's not something that's on ISE's list of strategic alternatives for a couple of reasons. One, ISE is not a private company. We're a publicly owned company in that we are owned by Eurex, which is owned by Deutsche Börse Group and the SIX Swiss Exchange. And clearly would be up to them if they wanted to sell a piece of the business.
They haven't approached you then, I assume?
They're very happy with their ownership of ISE. And we continue to be a strong player in the market and a leader in the options industry. And we've begun to move into other areas of business. We own 31% of Direct Edge, which is the third largest exchange in the United States. We own a piece of QuadraServe, which is a stock loan exchange that's centrally cleared and transparent. We're very excited about that ownership. And we just made a strategic investment in Hanwick Associates, which is a technology company. They, in fact, presented here at the conference. So we're growing in other areas, and all of that profitability accrues to our owners. If they sell off a piece of the business, then yes, they're selling a piece of the business to potentially attract order flow, but at the same time, they're no longer getting the 100% return on the profitability when that flow comes in. And that's a balance that every exchange and every ownership group has to work out for themselves.
Curious, as everyone seems to be embracing this model in some shape or form, what the end result of it will be. There's a finite number of large liquidity providers. There's a finite number of large order flow providers. If everyone is selling a piece to the same handful of firms, it seems at the end of the day, everyone's pretty much back at square one when everyone is kind of almost a cost of doing business now in the options space.
I agree with you. It's just a more sophisticated version of an old-style pricing war. You're just doing it differently. You're selling half your pricing to another entity. Well, that's the same thing as cutting your fees in half. So it's just a more sophisticated version of that same fight.
And speaking of competitors, there obviously is a new competitor in the space that has launched a few months ago. We're talking about BATS, obviously. And I'm curious, what is your opinion of BATS? Their two main value adds seem to be pricing as well as the ownership model that we just discussed. Do you feel that overall that approach is going to be additive to the business to grow the pie, as you like to say, or do you think they're cannibalizing or even cherry picking, as some might say, the different types of order flow?
Well, I know Joe Ratterman and Jeremy Johnson very well. I have a great deal of respect for what they have accomplished already in the equities business, both here in the United States and in Europe. And they've put together a very good group of people that are working at the exchange. It's very early to tell what their success will be with the maker-taker model as they have rolled it out today. I've always believed that a successful exchange is one that brings value-added product to the business and one that is focused on growing the pie. If all they're doing is replicating the model of another exchange, then I think it will be challenging for them because there are a lot of exchanges in the option space. But I have too much respect for them to believe that that's their entire plan. I just haven't seen their entire plan rolled out yet. So it's still early, and I'm going to wait to see what they're going to be doing.
So they have more innovations waiting in the wings, you think? It's interesting to see because, a few years ago when Box launched, everyone complained there was no space in the industry for another exchange. But yet Box launched around a core innovation, which was the PIP, which was a great idea, which everyone promptly copied. Since then, the new exchanges have come in, and I haven't seen that degree of innovation, at least not from my perspective with them. They're experimenting with different pricing models, experimenting with different ownership models. But, the core innovation, which is what you would think you would want to launch an exchange around, at least I haven't seen. And I know just talking to some of the other exchange heads here, and Ed Boyle is a very vocal proponent of this. He feels some of these new entrants are coming in and almost taking some of the low-hanging fruit. Anyone can come in and list front month Google and the Qs and a few other things that are highly liquid and make some money in those. Whereas, he feels that some of the traditional exchanges are left holding the bag, quoting the deeps, the out of the money, in the money stuff, the illiquid options that very few people trade. And I'm curious, I've asked him and asked others about this and what your opinion about this is. Would you support some sort of minimum quoting requirement, minimum display requirement for new entrants into the option space?
The ISE quotes every single series that's listed. We've always seen ourselves as a full-service exchange. And in a marketplace that is so dependent on technology and the sophistication required to be able to process 280,000 different series that are quoting continuously throughout the day, require that we invest a certain amount of money in maintaining and upgrading our technology on a regular basis. When an exchange cherry picks, the term that you used, and only quotes in a few series, and I'm a little surprised to hear Ed say that that's a problem, because that's what ARCA has been doing. It is easier to do that. You don't need the technology in order to quote in only 5,000 series. But I also have no fantasy that is a realistic requirement that will be ever set up by our regulator. They believe in competition and free competition. And if somebody wants to come in and provide a service of only 5,000 series being traded, the SEC would probably say that if the customers don't want that, they won't support the exchange. And if they do want that, then they will send order flow there, and the exchanges will have to learn how to compete in that environment. So while I don't think it's fair, and it is a challenge, at the same time we have customers who support us because they see that we're providing them a menu with many choices in our restaurant rather than the same dinner every night. But that's up to the customer.
Now, we spoke a little bit about BATS, but obviously there are other exchanges rumored to be on the horizon. Cboe has obviously been talking about C2 for quite a long time now. There is talk that will come online sometime this year. Another one that's frequently mentioned is one you just spoke about, which is Direct Edge, and perhaps they are eyeing a foray into the options business. And I'm curious if you want to comment on that in any way, shape, or form, and what you may think may be in the future for Direct Edge.
Well, I'm a board member of Direct Edge, so I would always cede that to Bill O'Brien to answer, and I think it's more appropriate that the CEO of the company answer that, and I'm sure he would be thrilled to be invited onto the program, but I think it's more appropriate that he take that one.
We have so many monolithic organizations now. NYSE has Amex and NYSE, where they can do a multiple model approach. NASDAQ and PHLX can take a multiple model approach. Cboe is launching C2, so obviously they can go after that multiple model approach as well. You're experimenting with that to a limited degree in ISE, but it seems like the launch of a new exchange that you would have at least partial ownership in would allow you to pursue that in a much greater fashion than you can do on the ISE right now. It would seem to make strategic sense as you're positioning against some of these other monoliths out there who have multiple models under the same umbrella. I'll just leave that out there for you to mull over.
Thank you. I'm going to hire you on my strategic planning committee.
Well, Gary, I'm glad we can get you back on the show, and that's about all I have for you, unless there's something that you would like to add.
Well, one, I just like to describe the state of the conference as it wraps up here, and just share with the audience how wonderful it was to see 500 attendees come here to Phoenix, Arizona, and spend a great deal of time talking about the important issues of the day, whether they be regulatory reform, innovation, what's going on in Washington, the equities markets. The panels have been outstanding. We had a great keynote speaker in Malcolm Gladwell, and I think he left everybody with the thought of, why am I trying to process 300 emails a day? It's just too much information for me to handle. So we come away from this conference with a sense that there is a lot in store for the options industry. The theme of the conference was a new decade in options, And I have to say that I'm more excited about the next 10 years, even more so than I was about the last 10.
You know, mentioning the audience has made me think of one last point that I did want to discuss with you, which is the changing nature of the options audience, especially at a conference like this. In years past, this has been a primarily institutional audience. And yet, in recent years, when we recorded our OIC programs and pushed them out to what you consider to be heavily retail platforms like iTunes, this type of content, OTC credit default swap clearing and things like that, have risen to the top of the charts and done very well. So there obviously is a strong overlap of interest in there from, I could say, the more dynamic and growing aspect of the options market, which is the high-end retail. That audience seems to really be dovetailing very nicely with the institutional audience these days. I know Schwab did a study of their active trader demographic. A significant percentage of them said they were paying attention to derivatives reform in Washington. If you had told me that a retail audience would be watching and paying attention to derivatives reform a few years ago, I would have said, you're crazy. That's the bailiwick of this institutional audience. So I'm curious, maybe speaking to the conference and to the demographic in general, what's your opinion of this changing trend and how we're seeing the real emergence of this high-end retail market and how they're really starting to blend with the institutional market?
The entire nature of our customer group has changed over the last 20 years. A product that used to be primarily in retail, 80% retail, 20% institutional, has now moved to a 50-50 ratio, but it's not just that the institutional volume grew and that the retail volume remained constant. It's that the retail customer has changed completely. What used to be simple buys of calls and puts, what some would call true speculation and betting on the market, has mutated to a more responsible use of the product. They're better educated than they ever were before. The retail customer has more tools than they ever had in their arsenal before. Your program and the material that you have on the website is a perfect example of that. A customer used to have to wait 9 months before a traveling roadshow would come through their city, and maybe they could listen to an options class for an hour and a half on a Thursday night in the rain. Now you can go online and download material, read it in your free time, watch a webinar. You can go to different websites and simulate trading techniques and learn about different functionalities. The entire experience of trading options has dramatically changed and is continuing to change.
Well, I think the response to this content that we're doing here at this show will be an indicator of just how much interest there is. If it's similar to years past, it might be time to start thinking about maybe opening up the conference even more, maybe having day passes. Obviously, there is a strong interest from that retail component in this type of content, in this type of material. They want to know what's going on in the industry. I mean, we have retail customers now asking us about maker-taker versus traditional models, things that I never would have anticipated a few years ago. So there is definitely a level of nuance and sophistication in that audience that is very surprising. And I think there's a lot we can do to reach out to it even further, both online and at events like this down the road.
Yeah, it's a very encouraging sign that the interest is growing. The FIA, which is a Futures Industry Association, combines with the Options Industry Council, our own industry association, twice a year for a conference like this. One is held in Chicago and the other is held in New York. And parallel to that conference, there are day passes for investors who come in and take classes in these products.
Those are for education, right? But they don't really get into the industry stuff that apparently they have a desire to hear.
Well, that's wonderful to hear, and it's something that we should think about. What's the best way to deliver and quench their thirst for the information?
Of course, I'm saying this to the man who just finished his conference and won't be up again for another at least 4 or 5 years. So it's just something to mull about until the next conference comes around. But Gary, I'm very glad to have you back on the show, and we'll definitely have to bring you on again down the road to talk about some of these developments we're seeing in the options business, as well as your own very personal and dynamic crusade against the dividend trade. We love to talk about it. So Gary, thanks for coming on the show.
Thank you very much, Mark.
And that's going to do it for this episode of Options Insider Radio. Be sure to visit www.theoptionsinsider.com for more episodes of this program, as well as breaking news from the options market, the latest articles and analysis from options experts, a wide variety of options education, and of course our discussion center where you can share your questions, comments, and insights with your fellow Options Insider users. While you're there, be sure to register for our monthly email newsletter, as well as our free email alert system.
Our email alert system makes it even easier to stay up to date on the latest content from theoptionsinsider.com. Thanks again for listening. My name is Mark Longo, and I'll see you next time on Options Insider Radio.
Options Insider Radio was created by Mark Longo and produced by Gene Crotty. Options Insider Radio is a production of the Options Insider Incorporated, all rights reserved.